Hello everyone, welcome back to our channel where we talk all things finance and investing. And I want to give a shout out to Tony Robbins and Peter Mallouk for their book, Unshakeable, Your Financial Freedom Playbook. And they talk about 4 core principles for making sound investment decisions. We're going to talk about that today. The first principle is don't lose money. Of course, who wants to lose money in any endeavor that you're involved in? And it could even be gambling if you're buying lottery tickets. You know, I'm sure no one likes to lose money. But we're talking about investing. Now, let's say you put your investment, let's say you put all your investment funds into a particular stock, and that stock was to drop by 50%. Don't you realize that it has to go up a whopping 100% just for you to break even? You definitely don't want to do that. So to avoid losing so much money, we do what we call an asset allocation plan. So just imagine if you have $10,000, you can split that $10,000 up into 5 separate buckets. You put $2,000 in bucket number 1, $2,000 in bucket number 2, and basically $2,000 in all of the 3 buckets. The idea here is that if for whatever reason one of the buckets doesn't work out, the ideal is that the other 4 should make up the difference. Let's go to core principle number 2. It's what we call asymmetric risk to reward. And what we want to do here is basically we want to minimize how much capital we put at risk for a reward we expect. Ideally, we want to make more reward and less risk. Let's say you want to make $5 off your investment, but you're only going to risk $1. That's an example of what we call asymmetric risk to reward. And I'm going to cover that in a video toward the end of this one, showing you just how we do that. So hang on and we'll illustrate how you do that. The next thing we want to talk about is core principle number 3. And what you want to do with your investment, you want to invest tax efficiently. And that's by putting your funds into an account that is tax deferred, something like a 401k, a Roth IRA, a traditional IRA, or if you have kids that's going to go to college in the future, you'll put it in what we call a 529 plan. Now, I did mention Roth IRA. It's a little different than traditional. The reason it's different is that you pay taxes today, but as your investment grows, you do not have to pay tax later when you pour those funds out. The other tax deferred accounts, you have to pay taxes when you pour the money out. But in the meantime, while you're growing, you do not have to pay taxes on it. And the reason why that's such an advantage is that it allows your money to continue to grow compounding without being impacted by taxes. The next principle I want to talk about is diversification. Now, why diversification? Diversification is just like core number 1, which is don't lose money, which is an asset allocation plan. Remember when you took the $10,000 and you put it into 5 separate buckets of $2,000. Well, the idea with diversification is that you invest in each one of those buckets into industries that are completely unrelated to each other. What you don't want to do is make all those buckets into the same industry. Let's say banking stocks. You put one into Bank of America, another one into Wells Fargo, so on and so forth, into bank stocks. Then all of a sudden some negative news comes out that impact the bank industry. What happens is you're going to be impacted way more than somebody who diversified in separate industries, and you're going to see that big drop in your portfolio. So in conclusion, let's go over the 4 plans. First, don't lose money. Second, you want to build your money into what we call an asymmetric investment strategy. That way you get more reward and less risk. Third, you want to put your funds into a tax efficient account where basically it's tax deferred, so it gives your money a chance to grow through your investment over time. And the last thing you want to do is you want to make sure that those investments are diversified across different industries. Something to consider. Let's look at BITO, where it closed yesterday at $31.14. Now, I said I was going to discuss risk to reward and how we get an asymmetric advantage. So if you look at the chart here, you'll notice, as I mentioned before, that BITO closed at $31.14. Now, if you go all the way down to the low area, where the historical low in recent times, at least as far back since September of last year, you'll notice it's around $14. And as we said, the high is around $31.14, which happened yesterday. If you pull up the option chain and you look at the put for BITO, you look at a strike price of $15. You see that it's paying between $1.50 and $2.25 per share. Now, when you're selling a put option, your break even for a put is the strike price minus the premium. So in this case, the strike price is $15 and the premium that it's paying, let's say it's paying at about $1.50. So that means your break even price is $13.50. So if BITO was to go down below $12.50, you risk to lose $1 per share. That means you decide to get out at that point. But if BITO doesn't go below $12.50, yet somehow it managed to get below $13.50, you get a reward that could be potentially greater than $10 because, as we said earlier, the recent high was $31.14. In any case, if it never goes down to those low levels, you still earn $1.50 per share. To help you understand how I identify investment opportunities. But remember that I am just a guy on YouTube sharing with you my personal ideas. Please do your own research or consult an investment advisor, as speculating or investing in the stock market carries risk.
Hey, everyone. I need your support on YouTube. Please subscribe to my channel so I can keep sharing helpful tips.